The role of bonds in your portfolio. On most people think about investing, their minds immediately go to stocks. They think about price charts, earnings growth, exciting companies, and the possibility of high returns. Stocks dominate financial headlines, social media discussions, and investment conversations, yet some of the most disciplined and successful investors in history have always emphasized a quieter, steadier component of a well-constructed portfolio: bonds. Benjamin Graham, widely regarded as the father of value investing and the mentor of Warren Buffett, is often remembered for his insights into stocks. However, Graham never believed that intelligent investing was only about equities. In fact, he repeatedly emphasized that bonds play a crucial role in protecting capital, stabilizing returns, and providing psychological comfort to investors, especially during periods of uncertainty and market stress. In this extended discussion, we will explore the role of bonds in your portfolio from the perspective of long-term, defensive investing. We will look at why bonds matter, how they reduce risk, how they generate income, and how they help investors stay disciplined when markets become volatile. More importantly, we will examine how bonds fit into a balanced investment philosophy, designed not for speculation, but for financial survival and long-term success. To understand the value of bonds, we must first understand the nature of risk in investing. Risk, in Graham's view, was not volatility. It was not short-term price movement. Risk was the permanent loss of capital. Bonds, when selected carefully, are one of the most effective tools available to reduce that risk. They may not be exciting, they may not make headlines, but they perform an essential function that allows investors to stay invested, sleep well at night, and avoid catastrophic mistakes. Let us begin by understanding what bonds really are. A bond is a loan. When you buy a bond, you are lending money to a government, a corporation, or another institution. In return, you receive interest payments at regular intervals, and at maturity, you receive your principal back, assuming the issuer remains solvent. This simple structure makes bonds fundamentally different from stocks. Stocks represent ownership. Bonds represent obligation. Because bondholders are creditors, not owners, they typically face lower risk than shareholders. In the event of financial trouble, bondholders are paid before equity holders. This priority of claims is one of the reasons bonds are considered safer instruments than stocks, especially when issued by financially strong entities. Benjamin Graham placed great importance on this distinction. He believed that investors should never expose their entire capital to the uncertainties of equity ownership. Instead, a portion of capital should be allocated to high-quality bonds, which serve as a stabilizing force within the portfolio. One of the primary roles of bonds is capital preservation. Capital preservation is the foundation of intelligent investing. Before an investor can think about growth, they must ensure survival. Bonds, particularly government bonds and high-grade corporate bonds, are designed to protect capital. They offer predictable income and defined maturity values, which reduce uncertainty. During periods of market turmoil, stock prices can decline sharply and unpredictably. Investor emotions intensify, fear replaces rational judgment. In such environments, bonds tend to hold their value better than stocks. In many cases, they even rise in price as investors seek safety. This defensive characteristic allows bonds to offset equity losses and reduce the overall volatility of the portfolio. Graham understood that investors are not purely rational beings. Emotional resilience matters. A portfolio that swings wildly in value can lead even disciplined investors to make poor decisions. By including bonds, investors reduce emotional stress and increase the likelihood of sticking to their long-term plan. Another critical function of bonds is income generation. Bonds provide regular, predictable income through interest payments. This income can serve multiple purposes. For retirees, it can support living expenses. For long-term investors, it can be reinvested to compound returns. For conservative investors, it provides reassurance that the portfolio is producing tangible cash flow regardless of market conditions. Unlike dividends from stocks, which can be reduced or eliminated during downturns, bond interest payments are contractual obligations. As long as the issuer remains solvent, payments continue. This reliability makes bonds especially valuable during economic slowdowns, when corporate profits decline and dividend cuts become common. Benjamin Graham valued income not because it was exciting, but because it was dependable. He believed that investment returns should be grounded in reality, not speculation. Bonds embody this principle by providing returns that are contractual rather than hopeful. Let us now consider the role of bonds in diversification. Diversification is often misunderstood. Many investors believe diversification simply means owning many stocks. Graham rejected this idea. True diversification, in his view, meant spreading risk across fundamentally different asset classes with different risk characteristics. Stocks and bonds respond differently to economic conditions. When growth is strong and optimism is high, stocks tend to perform well. When uncertainty rises, interest rates fall, or recessions occur, bonds often outperform equities. This inverse or low correlation helps smooth overall portfolio performance. By combining stocks and bonds, investors create a portfolio that is more resilient across economic cycles. Losses in one area are often offset by stability or gains in another. This balance reduces drawdowns and helps investors stay invested over the long term. Graham often suggested that defensive investors maintain a balanced allocation between stocks and bonds, adjusting within reasonable limits based on market conditions, but never abandoning either asset class entirely. His famous guidelines suggested a range never less than 25% and never more than 75% in either stocks or bonds. This disciplined framework prevents extreme behavior. It stops investors from becoming overly aggressive during bull markets and overly fearful during bear markets. Another important role of bonds is psychological stability. This aspect is rarely discussed, yet it may be one of the most important. Investing is as much about behavior as it is about analysis. The best investment strategy is useless if an investor cannot stick to it during difficult times. Bonds act as an emotional anchor. When stock markets fall sharply, investors with bond holdings experience smaller overall losses. This reduction in pain helps prevent panic selling. It allows investors to think clearly, rebalance rationally, and even take advantage of opportunities. When stocks become undervalued, Graham believed that the greatest enemy of the investor was not the market, but themselves. Bonds help neutralize this enemy by reducing volatility and emotional stress. Let us now explore different types of bonds and how they fit into a conservative investment framework. Government bonds, particularly those issued by stable governments, are considered the safest bonds available. They carry minimal default risk and are often used as a benchmark for risk-free returns. While their yields may be low, their reliability makes them valuable for capital preservation. High-grade corporate bonds offer higher yields than government bonds, but carry slightly higher risk. When issued by financially strong companies, they can provide an attractive balance between safety and income. Lower quality or high-yield bonds offer higher interest rates, but come with greater risk of default. Graham warned against reaching for yield without sufficient margin of safety. For defensive investors, safety should always take precedence over yield. Inflation-protected bonds can help preserve purchasing power during periods of rising prices. These instruments adjust their principal or interest payments based on inflation, reducing the erosion of real returns. Each type of bond serves a different purpose. The key is not to chase yield, but to align bond selection with the overall objective of stability, income, and capital protection. Another overlooked benefit of bonds is their role during rebalancing. Rebalancing is the process of restoring a portfolio to its target allocation. When stocks rise significantly, they can become an outsized portion of the portfolio, increasing risk. Bonds can be sold to buy undervalued stocks, or vice versa. This disciplined process forces investors to sell high and buy low, precisely the opposite of emotional investing behavior. Bonds provide the dry powder needed to take advantage of market dislocations without selling stocks at depressed prices. Graham viewed rebalancing not as a tactical move, but as a core discipline of intelligent investing. Now let us address a common criticism. Bonds offer lower returns than stocks. This is true over very long periods. Stocks have historically outperformed bonds. However, this does not make bonds inferior. It makes them different. The purpose of bonds is not to maximize returns, it is to reduce risk. stabilize income, and protect capital. Without bonds, many investors would not be able to tolerate the volatility required to earn equity returns. Graham would argue that the best portfolio is not the one with the highest theoretical return, but the one that an investor can hold through all market conditions. In periods of low interest rates, investors often question the value of bonds. They see low yields and conclude that bonds are unattractive. Graham warned against such short-term thinking. The role of bonds does not disappear when yields are low. Their defensive function remains intact. Even low-yielding bonds can provide diversification, stability, and psychological comfort. Removing them entirely increases risk. Even if expected returns appear higher on paper. Finally, we must emphasize Graham's central principle: margin of safety. Bonds contribute to margin of safety by reducing dependence on uncertain future growth. They provide known outcomes in an unknown world. They limit downside risk and preserve flexibility. A portfolio without bonds is like a building without a foundation. It may look impressive during calm conditions, but it is vulnerable to collapse when stress arrives. In conclusion, the role of bonds in your portfolio is not optional, it is essential for long-term, intelligent investing. Bonds protect capital, generate income, reduce volatility, improve diversification, and support disciplined behavior. They allow investors to endure market storms and remain invested for decades rather than reacting emotionally to short-term events. Benjamin Graham's legacy is not about chasing excitement. It is about building portfolios that survive, endure, and compound steadily over time. Bonds are a quiet but powerful part of that legacy. In a world obsessed with rapid gains and speculation, bonds remind us of a simple truth: investment success is not about brilliance, but about discipline, balance, and patience. And in that balance, bonds play a role that cannot be replaced. It is important to move beyond the basic mechanics and examine how bonds function across different economic environments. Benjamin Graham consistently emphasized that investing should not rely on predictions. Instead, it should rely on preparation. Bonds are a preparation tool. They are designed not for optimism, but for uncertainty. Economic cycles are unavoidable. Periods of expansion are followed by contractions. Interest rates rise and fall. Inflation accelerates and decelerates. Political events, wars, technological disruptions, and financial crises all introduce instability into markets. Stocks react strongly to these forces because their value depends on future expectations. Bonds, by contrast, are anchored in contractual obligations. This difference makes them uniquely valuable during unpredictable times. During recessions, corporate earnings decline, consumer confidence weakens, and equity valuations often compress sharply. Investors who rely solely on stocks experience both financial and emotional strain. However, bonds, particularly high-quality bonds, often perform a stabilizing role. Interest rates are frequently reduced during recessions to stimulate economic activity. As rates fall, bond prices tend to rise. This dynamic allows bonds to offset equity losses and reduce overall portfolio drawdowns. Graham viewed this counterbalancing behavior as essential. He believed that an investor should never place themselves in a position where survival depends on favorable market conditions. Bonds ensure that survival does not depend on optimism. Another critical dimension of bonds is their role in time-based financial planning. Different financial goals require different risk profiles. Short-term goals such as funding education, purchasing a home, or covering living expenses cannot tolerate high volatility. Bonds are particularly well suited for these objectives because they offer predictable cash flows and known maturity values. Long-term investors often assume that they can tolerate volatility indefinitely in theory. This may be true in practice. Life intervenes, job loss, health issues, family obligations, or unexpected expenses can force investors to liquidate assets at unfavorable times. Bonds provide liquidity and stability that allow investors to meet obligations without selling equities during market downturns. Graham emphasized that intelligent investing must account for real human circumstances, not idealized assumptions. Bonds align investment strategy with reality. Let us now consider interest rate risk. A common concern among bond investors, bond prices move inversely to interest rates. When rates rise, bond prices fall. This relationship often leads investors to avoid bonds during rising rate environments. However, Graham would argue that this concern is frequently overstated. First, rising interest rates eventually lead to higher yields on newly issued bonds. Investors who reinvest interest payments benefit over time. Second, short and intermediate-term bonds experience less price volatility than long-term bonds. Third, a diversified bond ladder where bonds mature at different intervals reduces exposure to rate changes and improves reinvestment flexibility. More importantly, Graham would remind investors that interest rate movements affect all asset classes. Rising rates often compress stock valuations as well. Eliminating bonds does not eliminate risk, it simply concentrates it. Bonds also play a critical role in protecting investors from deflationary environments. Deflation-FAL. Ling prices and economic contraction is particularly harmful to equities. Revenues decline, debt burdens increase, and corporate profits suffer. Bonds, especially those with fixed interest payments, gain real value in deflationary periods. The purchasing power of interest income increases as prices fall, while inflation tends to receive more attention. Deflation has historically caused severe financial damage. Graham believed that portfolios should be prepared for both scenarios. Bonds provide that preparation. Let us now examine the concept of return of capital versus return on capital. Stocks primarily offer a return on capital. Investors hope that earnings growth and valuation expansion will generate higher prices in the future. Bonds, by contrast, emphasize return of capital. At maturity, the investor receives their principal back. This certainty is not exciting, but it is powerful. Graham believed that too much emphasis on return on capital leads to speculation. A disciplined investor values the assurance of getting their money back. Bonds institutionalize this discipline. Another underappreciated role of bonds is their function during prolonged market stagnation. Not all markets experience steady upward growth. History includes long periods where stock markets moved sideways for years or even decades. During such periods, equity investors may experience frustration and diminished returns. Bonds, through steady interest income, continue to compound quietly. Graham lived through periods where stock markets took decades to recover in real terms. His emphasis on bonds was shaped by experience, not theory. He understood that markets do not always reward patience quickly, and bonds help investors endure these stretches without abandoning their strategy. Now consider the role of bonds in valuation discipline. When bond yields are attractive, they provide a benchmark against which equity valuations can be judged. If stocks offer little margin of safety relative to bond yields, a disciplined investor may allocate more capital to bonds. This relative valuation framework prevents overexposure to overpriced equities. Graham believed that asset allocation should respond to valuation extremes, not forecasts. Bonds provide a rational alternative when stock prices become disconnected from underlying fundamentals. Let us also address the misconception that bonds are only for older investors. While bonds are often associated with retirement, Graham did not believe that age alone should dictate asset allocation. Risk tolerance, financial obligations, and emotional temperament matter more than chronological age. Younger investors may benefit from bonds by reducing volatility, improving discipline, and providing flexibility. Older investors may use bonds to generate income and preserve capital. The purpose differs, but the value remains. Bonds are not a sign of conservatism, they are a sign of prudence. Another important function of bonds is their role in crisis response. During financial crises, liquidity disappears quickly. Assets that seemed safe become difficult to sell. Prices become disconnected from fundamentals. In such moments, bonds, particularly government bonds, retain liquidity and trust. This liquidity allows investors to respond rationally. They can rebalance, meet obligations, or deploy capital into distressed assets. Investors without bonds are often forced to sell equities at the worst possible time. Graham believed that liquidity is a form of safety. Bonds provide it. We should also discuss inflation concerns more deeply. inflation erodes purchasing power and reduces the real value of fixed income. This risk is real and cannot be ignored. However, abandoning bonds entirely is not the solution. Instead, investors can manage inflation risk through diversification within the bond allocation using short maturities, inflation-linked securities, and periodic rebalancing. Graham's philosophy was not about eliminating risk, but about managing it intelligently. Every asset class carries risk. Bonds carry inflation risk, but equities carry valuation, earnings, and behavioral risk. Balance remains the answer. As we move forward, it becomes clear that bonds are not merely an asset class. They are a stabilizing system within the portfolio. They support discipline, reduce emotional error, and protect capital from irreversible loss. As we move deeper into the role of bonds within a long-term investment framework, we must address a subject that Benjamin Graham considered even more important than financial knowledge itself: investor psychology. Graham repeatedly argued that temperament, not intelligence, determines investment success. Bonds play a crucial role in shaping the temperament. Markets test investors not through logic, but through emotion. Fear, greed, impatience, and overconfidence are the true drivers of poor decision-making. Bonds act as a psychological stabilizer. They do not eliminate emotional pressure, but they reduce its intensity. When investors experience smaller drawdowns, they are less likely to panic. When portfolios generate steady income, investors feel less compelled to chase returns. This emotional buffering is not incidental, it is structural. A portfolio that includes bonds is designed to absorb shocks rather than amplify them. Graham understood that most investors abandon sound strategies not because the strategy is flawed, but because the experience becomes unbearable. Bonds make investing bearable. Consider the behavior of investors during major market declines. When equity markets fall sharply, investors without defensive assets often feel trapped. They watch their portfolios decline rapidly with no counterbalance. This helplessness leads to emotional capitulation. They sell not because valuations justify it, but because pain becomes intolerable. Bonds change this experience. Even when stocks fall, bond income continues. Bond values may hold steady or even rise. This creates a sense of control. Investors are no longer entirely dependent on market recovery. They can wait. They can rebalance. They can think. Graham believed that the ability to wait is one of the most valuable traits an investor can possess. Bonds provide the financial structure that makes waiting possible. Another psychological benefit of bonds is reduced regret. Regret is a powerful emotional force in investing. Investors regret buying at the wrong time, selling too early, or missing opportunities. Portfolios dominated by equities tend to magnify regret because outcomes are extreme. Either returns are spectacular or losses are devastating. Balanced portfolios generate fewer extreme outcomes. Gains may be smaller during bull markets, but losses are also less severe during downturns. This moderation reduces regret-driven behavior, which often leads to poor timing decisions. Graham did not believe in maximizing happiness through returns. He believed in minimizing unhappiness through discipline. Bonds contribute directly to this goal. Let us now examine how bonds influence investor behavior during bull markets. Bull markets are dangerous not because prices rise, but because discipline erodes. Investors become confident, then complacent, then reckless. They increase risk exposure precisely when risk is highest. Bonds serve as a restraint. They prevent portfolios from becoming overly concentrated in equities during euphoric periods. Rebalancing from stocks into bonds during bull markets feels uncomfortable. It feels like selling winners too early, yet this discomfort is precisely why rebalancing works. Bonds provide the destination for disciplined profit-taking. Graham warned repeatedly that the greatest investment mistakes occur during periods of optimism, not pessimism. Bonds act as a safeguard against this optimism. Another overlooked role of bonds is their contribution to decision clarity when portfolios are volatile. Investors are forced to make decisions under stress. Stress reduces cognitive capacity. Under stress, people simplify, overreact, and seek immediate relief. Bonds reduce stress by reducing volatility. A calmer investor makes better decisions. A calmer investor follows rules instead of impulses. Graham understood that clarity is not achieved through prediction, but through preparation. Bonds are a preparation tool. Now let us consider historical evidence. During the Great Depression, equity markets collapsed dramatically. Many investors lost not only wealth, but faith in investing itself. Those who held bonds, particularly government bonds, were far more likely to preserve capital and remain solvent. Bonds did not eliminate losses, but they prevented ruin. In the inflationary 1970s, stocks struggled for long periods. Bond returns were challenged by inflation. Yet diversified bond strategies still provided income and structure. Investors who abandoned bonds entirely often replaced them with speculative assets, compounding their problems. During the 2008 global financial crisis, bonds once again demonstrated their defensive value. While equities experienced severe declines, high-quality bonds rose sharply. Investors with balanced portfolios experienced smaller drawdowns and recovered faster. These episodes reinforce Graham's central message: markets will test investors in ways they cannot predict. Bonds are not designed to win every battle, but to ensure survival across all of them. Let us now discuss the concept of investment sleep quality. While rarely mentioned in academic literature, sleep quality is a practical indicator of portfolio suitability. A portfolio that causes anxiety, constant monitoring, and emotional distress is poorly designed, regardless of its theoretical returns. Graham believed that investments should be sound enough to allow investors to ignore daily market fluctuations. Bonds contribute directly to this ability. They reduce the need for constant vigilance. They allow investors to step back and view markets rationally rather than reactively. An investor who sleeps well is more likely to invest well. Another essential function of bonds is providing optionality. Optionality refers to the ability to respond to future opportunities. Bonds provide liquidity and stability that allow investors to act when opportunities rise. During market downturns, when assets are mispriced and fear is widespread, bonds provide the capital needed to buy undervalued equities. Without bonds, investors often lack the flexibility to act. They are fully invested in declining assets and emotionally exhausted. Graham viewed this lack of flexibility as a strategic weakness. Bonds preserve optionality. We should also address the modern tendency to dismiss bonds as obsolete. In recent years, prolonged equity bull markets have led many investors to question the relevance of bonds. Low interest rates have reduced yields, and strong equity performance has made bonds appear unnecessary. Graham would caution strongly against extrapolating recent conditions into the future. Markets are cyclical. What appears unnecessary in one period becomes essential in another. Bonds are not included because of recent performance, but because of their function across full cycles. Graham warned investors against confusing favorable conditions with permanent conditions. Bonds protect against this confusion. Let us now examine how bonds align with Graham's definition of investment versus speculation. Graham defined investment as an operation that, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these criteria are speculative. Bonds, when properly selected, fit squarely within the definition of investment. They promise safety of principal through contractual repayment. They promise adequate return through interest income. Stocks, while capable of higher returns, do not offer the same certainty. Graham believed that intelligent investors should anchor their portfolios in investments, not speculation. Bonds provide that anchor. As we move toward the later stages of this discussion, it becomes increasingly clear that bonds are not a secondary consideration, they are a structural necessity. They influence behavior, protect capital, stabilize returns, and preserve discipline. ****, it is time to move from philosophy into practical structure. Benjamin Graham was not only a thinker. He was a system builder. He believed that successful investing required clear rules that could be followed consistently, even when emotions ran high. Bonds were central to those rules. Graham did not believe that investors should constantly adjust their portfolios based on forecasts, headlines, or economic predictions. Instead, he advocated for simple allocation ranges that created discipline. Automatically, One of his most enduring ideas was that investors should always hold both stocks and bonds, and that neither asset class should ever be allowed to dominate the portfolio completely. His general guideline was straightforward. The defensive investor should maintain a balance between stocks and bonds, with neither allocation falling below 25% nor rising above 75% within this range. Adjustments could be made based on valuation and market conditions, but extreme positions were to be avoided. This framework was not designed to maximize returns. It was designed to minimize mistakes. Bonds served as the stabilizing half of this balance when stock prices rose significantly and valuations became stretched. The investor would gradually shift capital into bonds when stock prices fell and valuations became attractive. The investor would shift capital back into equities. Bonds were not static holdings, they were active tools for discipline. Graham emphasized that this approach did not require market timing, it required valuation, awareness, and emotional restraint. Bonds provided a safe destination for capital when caution was warranted. Let us now examine how bond allocation evolves across different stages of an investor's life. In the early stage of investing, time is often considered an advantage. Younger investors are frequently encouraged to allocate heavily toward equities, under the assumption that volatility can be tolerated and losses can be recovered. While this reasoning has merit, Graham would caution against extremes. Even early-stage investors benefit from bonds, not because they need income, but because they need discipline. Bonds reduce volatility, encourage saving consistency, and prevent overconfidence during bull markets. They also provide liquidity for life events that may arise unexpectedly. A modest bond allocation in early years helps build habits of balance and patience, habits that become invaluable later in life. In the mid-stage of investing, responsibilities typically increase. Families, mortgages, career transitions, and financial obligations place greater demands on capital. At this stage, bonds play a more visible role. They protect accumulated wealth and provide stability during periods of uncertainty. Graham believed that as financial obligations increase, the margin for error decreases. Bonds reduce the consequences of error. They ensure that a single market downturn does not derail long-term plans. In the later stage of investing, preservation becomes paramount. The ability to recover from large losses diminishes as time horizons shorten. Bonds provide predictable income and reduce dependence on market appreciation. They transform portfolios from growth engines into financial support systems. However, Graham did not advocate eliminating stocks entirely in later years. He believed that some exposure to equities was necessary to preserve purchasing power and combat inflation. The key was balance, not elimination. Now let us consider how modern investors can apply Graham's bond principles in today's markets. The financial landscape has evolved. New instruments exist, interest rates fluctuate in unfamiliar ways, yet the underlying principles remain unchanged. Bonds still serve the same core functions: stability, income, and discipline. Modern investors may use bond funds, exchange-traded funds, or individual bonds. The form may change, but the purpose does not. The emphasis should remain on quality, diversification, and suitability. Graham would strongly caution against reaching for yield by investing in low-quality bonds. High yields often reflect high risk. The purpose of bonds is not to replicate equity returns, but to provide safety. Compromising quality undermines this purpose. Another practical consideration is bond maturity structure. Holding bonds with a range of maturities, often referred to as a bond ladder, reduces exposure to interest rate risk and improves flexibility. As bonds mature, capital can be reinvested at prevailing rates. This structure smooths income and reduces dependence on any single interest rate environment. Graham valued simplicity. A simple ladder of high-quality bonds aligns well with his philosophy. Let us also examine how bonds interact with inflation over long periods. Inflation is a legitimate concern for bond investors. Fixed interest payments lose purchasing power when prices rise. Graham acknowledged this risk, but did not view it as a reason to abandon bonds. Instead, he viewed it as a reason to maintain diversification. Stocks, real assets, and inflation-protected securities can complement bonds in addressing inflation risk. The solution is balance, not concentration. Bonds provide stability, while other assets address growth and purchasing power. Graham believed that no single asset class offers complete protection. Intelligent investing is about combining imperfect tools in a way that reduces overall risk. Another practical benefit of bonds is their role in funding future commitments. Many financial goals have fixed time horizons, tuition payments, retirement withdrawals, planned expenses. Bonds align naturally with these commitments because their maturity structure can be matched to future needs. This reduces uncertainty and eliminates reliance on market timing. Graham believed that matching assets to liabilities was a hallmark of intelligent financial planning. Bonds make this matching possible. Let us now address the temptation to abandon bonds during prolonged equity outperformance. Periods of strong stock market performance often lead investors to question the need for bonds. This temptation is understandable but dangerous. Graham warned that the time to be cautious is when caution feels unnecessary. Bonds are most likely to be abandoned precisely when they are most needed. Their absence is rarely felt during good times, but deeply felt during bad times. Graham's allocation rules exist to counter this tendency. They enforce discipline when discipline is hardest to maintain. As we move forward, it becomes increasingly clear that bonds are not a passive component of a portfolio. They are an active force shaping behavior, structure, and outcomes. As we arrive at the final stage of this long discussion on the role of bonds in your investment portfolio, it is important to step back and reflect on the larger lesson Benjamin Graham sought to teach. Graham was not attempting to create brilliant investors, he was attempting to create resilient ones. Bonds are central to that resilience throughout market history. Fortunes have been made and lost not because investors lacked intelligence, but because they underestimated risk, overestimated their tolerance for volatility, and abandoned discipline at precisely the wrong moments. Graham observed this pattern repeatedly across decades of market cycles. His solution was not complexity, but structure. Bonds provided that structure. One of Graham's most enduring insights was that investing is not a competition against others, but a negotiation with oneself. The investor's greatest challenge is not identifying opportunities, but surviving inevitable adversity. Bonds exist to ensure survival. Survival, in Graham's philosophy, is not passive, it is active defense. It is the conscious decision to avoid situations where a single adverse event can cause permanent damage. Bonds limit exposure to uncertainty. They reduce reliance on optimistic assumptions. They transform portfolios from fragile systems into durable ones. A portfolio dominated entirely by equities may look impressive during favorable conditions, but it is inherently vulnerable. It depends on continued growth, stable markets, and favorable sentiment. Bonds reduce that dependence. They introduce certainty into an uncertain world. This certainty does not eliminate risk, but it bounds it, and bounded risk is manageable risk. Another critical idea that emerges from this discussion is that compounding only works if capital remains intact. Investors often focus on rates of return while ignoring continuity. A high return achieved briefly is meaningless if followed by catastrophic loss. Bonds protect continuity. They ensure that capital remains available to compound over decades rather than being destroyed by a single misjudgment. Graham believed that avoiding major losses was far more important than achieving extraordinary gains. Bonds serve that objective quietly and consistently. It is also important to recognize that bonds are not a sign of pessimism, they are a sign of realism. Graham was not pessimistic about markets. He was realistic about human behavior. He understood that fear and greed are permanent features of investing, and that portfolios must be designed to function despite them. Bonds help investors remain rational when markets are not. They provide income when prices fall. They provide liquidity when fear dominates. They provide stability when emotions intensify. These qualities do not appear on performance charts, but they determine long-term outcomes. As markets evolve, instruments change, and technology advances, the relevance of bonds remains intact because the underlying problem they solve has not changed. Investors are still human. Markets are still cyclical. Uncertainty is still unavoidable. Graham's principles endure because they are grounded in human nature rather than financial fashion. A final misconception worth addressing is the idea that bonds must be exciting to be useful. Graham rejected this notion entirely. He believed that investments should be satisfactory, not thrilling. Bonds are not designed to stimulate excitement. They are designed to provide assurance. In investing, assurance is underrated. Assurance allows patience. Patience allows discipline. Discipline allows compounding. And compounding, sustained over long periods, is the true source of wealth. When viewed through this lens, bonds are not a drag on performance. They are a support system for performance. They make it possible for investors to remain invested through downturns, rebalance rationally, and take advantage of opportunities when fear dominates markets. Without bonds, many investors would abandon their strategies long before those strategies have time to work. Benjamin Graham did not promise investors freedom from losses. He promised them freedom from ruin. Bonds are one of the tools that make that promise credible. They are not a substitute for judgment, but they support it. They are not a replacement for growth, but they enable it. They are not an outdated concept, but a timeless safeguard. In the end, intelligent investing is not about forecasting markets or identifying the next great opportunity. It is about constructing a portfolio that can endure uncertainty, resist emotion, and function reliably across decades. Bonds make that endurance possible. They allow investors to step away from noise, ignore speculation, and focus on long-term objectives. They turn investing from a source of anxiety into a structured process grounded in reason. And that, ultimately, is what Benjamin Graham sought to teach. Not how to beat the market in a single year, but how to remain invested for a lifetime. Intelligent investing is not built on excitement. It is built on discipline. Bonds remind us that stability matters, that survival comes before growth, and that patience is a competitive advantage. In a world that rewards speed and speculation, they reward restraint, and in that restraint long-term success quietly takes shape.